Today we're joined by Mr. Dan Boscher, the Portfolio Manager of the Perennial Value Wealth Defender Fund. Dan, can you tell us a little bit about Perennial Value, your background and history with the company?
Sure. Well, Perennial Value is a long-only Australian equities fund manager with a value style. It's a 16-year business now, so there's a very experienced and large team with a long positive track record of generating good returns for investors in Australian equities looking for a value bias to their portfolio. I joined Perennial Value about 3 or 4 years ago, and my role is really to look after what we call the Wealth Defender business, which is a business designed to help mitigate sharp market falls around equity markets by the use of relatively simple derivative products embedded in those portfolios that sit alongside the equities portion of the funds. My background's in investment banking. I spent 15 years in investment banks running trading desks and so on and so forth. So with that experience, I think Wealth Defender combined with John and the team's long-term track record is a good combination for a product for lots of different investors.
Dan, given your focus on protection, what is your typical net invested position and how and why does that change over time?
Well, within the Wealth Defender portfolio, we have a mandate to be between 50 and 100% exposed to the equity market. But unlike most funds that seek to mitigate risk by selling equities, for example, we like to stay relatively fully invested in the equities such that we can collect dividends and franking credits and so forth, and use derivatives to provide that negative exposure to the market or that downside protection. So in essence, we're generally fully invested in stocks, and we might spend, say, $97 out of every 100 in stocks, but that $1 or $2 or $3 left over will buy protection strategies to go alongside them. So our exposure to the market will vary between 50 to 100, and that's a function of a number of things, whether it be our market view or some other reason for us to be less exposed to the market at a certain period of time. But we're using derivatives to do it, so we can stay fully invested in the share part, but give ourselves a degree of protection if markets do fall.
Dan, I'd like to spend a little bit of time now on the research process behind Perennial Value, with a particular reference to the Perennial Value Wealth Defender Fund. Can you explain to us what your investment objectives are behind the fund and what is your investable universe?
The second part of the question is relatively simple. The investable universe, Australian equities and derivatives. But the objectives of the fund, quite interesting. We have two main objectives really. One is to provide the long-term capital gains that Australian investors should enjoy in the Aussie equity market, but also as a second objective to try and mitigate those short, sharp falls that occur from time to time in equity markets.
Your strategy focuses on portfolio protection. Can you explain the investment philosophy behind your process?
Well, the strategy is really twofold. Obviously, we need to buy cheap stocks relative to the market to provide a value portfolio. So we're looking for well-priced businesses where we see long-term potential in terms of upside to price, but in terms of growth and so on and so forth. On the protection side, the philosophy is really about trying to be protected without having to time markets. So instead of turning risk on or risk off by buying or selling shares in the portfolio to create that exposure, we like to carry a permanent protection strategy such that we've always got some kind of downside protection in there, and that we're not really just relying on market timing or our current view of the market to deliver a positive outcome relatively to the benchmark when something unexpected happens and markets fall quickly.
In terms of process, how do you select stocks for the portfolio?
Perennial Value has a very strong strategic focus on how we actually manage the portfolio and select the shares that go into it. And it really comes back to that value style of investing. So we have a number of filters that we look at to determine whether or not a stock meets that criteria. The obvious ones being things like price to earnings ratio, price to free cash flow and dividend yield and so forth. So what we actually are doing is ranking the equity market by some of those factors and more, and from that choosing stocks that we think best suit the current environment, but more importantly suit that value focus.
You use option strategies for protection. What sort of market fall are you looking to protect?
Well, we're looking to protect all market falls, really. I mean, that's the objective. What we do find is when we carry protection on a permanent basis, we have to do it in a cost-effective way. So what we don't do is seek to, say, protect every 1 or 2% move in the market. You know, what we do try and do is protect the portfolio once the market started to derate. So, for example, after a 5% fall, we want to see some sort of value add from the protection strategy. What we also want to do in terms of cost effectiveness is make that protection pay off more often. If we carry just tail risk or very out of the money protection, for example, allow the investor to be exposed to, say, the first 20% fall, then that protection won't pay off very often. It might be cheaper, but what we find is that when markets fall, most of the time they fall between that, say, -5 to -20 amount. So it makes sense for us to focus our protection on that part of the downside, as it were. Now, that's not to say we don't care about markets falling by more than that, because of course we do. But in terms of managing that costs versus outcome equation, which is what we're really trying to do, we find that 5 to -20 is really where the sweet spot is. And it also helps us out in terms of cost management, how much we need to spend on protection going forward.
How important is the market outlook when you're looking to put protection in place?
Market outlook's always important. With respect to when we put protection in place, clearly if we're concerned about equity markets, we're likely to have more protection than less. And if we think equity markets are well priced and there's good upside and lower risk, then we'll have less protection. But what we're really trying to avoid is market timing. So we don't want to necessarily turn the protection to zero or back to full from one day to the next. We want to have a relatively constant level of protection and then adjust it from time to time depending on outlook of the market.
In general terms, what is the overall cost to the portfolio of having portfolio protection in place?
Firstly, we think of it as an investment rather than a cost, which is really, do I buy BHP, do I buy National Australia Bank, or do I buy more protection? So for us personally, it's more of an investment. The long run cost of buying options is somewhat expensive. So what we try and do is run a relatively active approach and mitigate the cost of owning protection. We don't want to spend more than 1 or 2% per annum on protection if we can avoid it. So that's really where our target is, and so far in nearly 2 years, we're well within that target. That's where we aim to get to.
Given your focus on protection within the portfolio, can your systems estimate the impact of market falls on the portfolio?
The systems that we run are very good at estimating what the outcome is going to be when markets move up and down. Derivative risk management obviously needs to be done properly, have the appropriate systems, and what our systems do is really give us a very accurate understanding as to what's going to happen to the portfolio if something happens in terms of market direction right now or tomorrow, for example. When we have big market falls, we know in advance essentially what the outcome is going to be because we already own the protection, and if the market moves to here, the value of that security goes to here, for example. So estimating on a daily basis or next day is pretty easy. Estimating over a long period of time is more difficult because we're not sure how long it's going to be till the market does what it does. So there's a degree of variability in slow market falls, and the outcome is going to be less effective than if it does fall quickly.
Does a protection strategy affect the income distributed by the portfolio?
It can. So if markets fall, for example, the protection strategy in theory should increase in value and generate a profit, which is treated as income. And if markets rise and the protection that we've bought goes to zero, then that will be a drag on income for the fund.
What sort of investor does the fund suit, and what's the recommended time frame for investment?
The fund suits all kinds of investors really, but because of that built-in protection strategy, it does suit those with a lower risk tolerance than, say, a normal share fund would. So particularly pre and post retirees find this kind of fund something that helps them get that sleep at night factor, for example. But more importantly, it's for all investors who want to generate long-term capital growth from investing in Australian shares.